Welcome to the Opening Bell Report.
All right, so I am looking at a number here in this analysis report, and I seriously need you to tell me if it is a typo, because it really looks like a typo.
Which one? There are a few pretty eye-popping numbers in this file.
The revenue projection. The analysis says they are projecting revenue growth for 2026 at 3,200%.
Yes. That is not a typo. That is the actual projection.
3,000%. That is, well, I mean, that is usually the kind of math you see in a pitch deck for a crypto scam or maybe a company that is about to go bust. It doesn't feel real.
It sounds completely like Fantasyland, I agree. But context is everything here. And the context is that we are looking at a company called Brand Engagement Network, Inc. Ticker symbol is BNAI. And despite that massive, almost unbelievable number, or maybe because of it, this financial analysis report has actually slapped a strong buy rating on the stock.
A strong buy on a stock that has been, frankly, incredibly volatile. I mean, I saw it surge 276% in a single week recently. That screams meme stock to me. That screams retail traders having a party, not a sound financial investment.
It certainly has that flavor on the surface. But our job today for this deep dive is to look at the analysis and figure out if this is just internet hype blowing a bubble, or if there is actually a real engine inside this thing. Because if that 3,000% growth is even half true, we aren't looking at a meme stock. We are looking at a major infrastructure play.
Okay, so let us pop the hood. The report centers heavily on this concept of sovereign AI. Now, I am going to be the skeptic here, because every single company on the planet right now says they are an AI company. My toaster is probably an AI company at this point. What makes sovereign AI different from, say, the standard chatbots we all use?
It is a really crucial distinction. Think about the big AI models we all use every day. They are open. They are trained on the entire internet. And generally speaking, when you type something into them, that data goes to their servers. It is processed in the cloud, often on shared infrastructure.
Which is totally fine if I am asking for a recipe for banana bread or something.
Exactly. But imagine you are a hospital system, or you are a pharmaceutical company developing a billion-dollar drug, or a bank managing high-net-worth accounts. Can you type your patient data or your proprietary formulas into an open AI model?
Absolutely not. I mean, that is a HIPAA violation, a GDPR nightmare, and a corporate espionage leak all wrapped into one. You would get sued into oblivion before lunchtime.
Precisely. And that is the underlying why behind sovereign AI. Sovereign here means the AI is secure, it is autonomous, and crucially, the data stays with the client. It is essentially a walled garden. BNAI builds human-like AI agents, chatbots, that are actually incredibly smart, but they operate within strict, secure boundaries.
So it is basically AI that has signed a non-disclosure agreement.
That is a fantastic way to put it. It is AI that will not hallucinate facts because it is rigidly restricted to the client's own data, and it will not leak that data to the outside world under any circumstances.
I see.
The analysis argues that this exact issue is the current bottleneck for enterprise adoption. Big companies desperately want to use AI to cut costs, but they are terrified of the liability. BNAI solves that liability problem.
Okay, conceptually, I get it. Safe AI for highly regulated industries like healthcare and finance. That sounds like a genuinely good business model. But I want to drag us back to reality for a second here, because I'm looking at the current financials in this report, and calling them modest is just the understatement of the century.
They are definitely, well, they are very early stage.
They are microscopic. The trailing 12-month revenue is roughly $75,000. $75,000. That is not a publicly traded tech company. That is a freelance graphic designer having a decent year.
Fair point.
How can analysts give a strong buy to a company that generates less revenue than a local coffee shop?
It is a perfectly valid critique. If you only look at the rearview mirror, you're absolutely right to be skeptical. The company has effectively zero revenue right now relative to its market cap. But the core argument in the report is that BNAI is currently undergoing a massive metamorphosis.
Meaning what exactly?
They are transitioning from a developmental startup, which is a phase where you just burn cash to build technology, to a commercial entity.
Transitioning is a word CFOs really love to use when they are losing a ton of money. You are going to have to prove it to me. Where does that 3,000% growth actually come from? Is it just hopes and dreams in a PowerPoint, or is there actual ink on paper?
This is exactly where the report gets really interesting. It is not vague at all. They cite the actual pipeline. The growth is not coming from selling small $50 a month subscriptions. It is coming from massive enterprise licensing deals that are kicking in right now.
Okay, walk me through them. What are these specific deals?
The biggest one mentioned is a partnership in Africa with a company called Valeo Technologies. It is a comprehensive AI licensing deal.
And the numbers on that?
$2.05 million.
Okay, so just to do the quick math in my head here, that one single deal is roughly almost 30 times their entire revenue from the last 12 months.
Exactly. That is why the percentage growth looks so completely absurd on paper. When you start from near zero, a $2 million deal looks like a rocket ship taking off. But it's not just value. They also have a major healthcare modernization deal in Mexico with a group called Sky Salud.
So we are definitely seeing a pattern here. Africa, Mexico. It seems like they aren't fighting for scraps in Silicon Valley against the big tech giants. They are going to global markets where maybe the infrastructure needs a massive leapfrog technology.
That is the strategy entirely. And the key word the analysts use repeatedly in the report is deployment.
Meaning it is already happening.
Yes. These aren't just pilot programs where they are testing the water for a few weeks. These are signed contracts for actual deployment. The report forecasts that revenue will hit a major inflection point of $1 million per quarter by late 2026.
Going from 75 grand a year to $1 million a quarter. That is the textbook definition of an inflection point.
It truly is. And if they hit that, the valuation models completely change overnight. You stop valuing them as a highly risky penny stock, and you have to start valuing them as a high-growth SaaS company.
And this is a massive, but we have to talk about the risks. Because if I am an investor looking at their balance sheet today, right now, without knowing about the African deal or the Mexican deal, it looks like an absolute disaster scene.
Oh, it is ugly. There's no sugarcoating the current financial snapshot.
I am reading the numbers right here. Operating income is negative $27.7 million. Net income is negative $33.72 million. The PE ratio is negative. They are burning cash at a rate that would make a bonfire jealous. Why shouldn't I look at that and just run for the hills?
If the story ended right there on that balance sheet, you should definitely run. But the strong buy thesis is built on what the report calls a de-risking narrative. They argue that the company has spent the last 12 months painfully cleaning up the mess to get ready for this commercial growth phase.
What does cleaning up look like in this specific context?
Two major things. First, the debt. As of early 2026, the company successfully paid off its debt obligations.
Okay, that is significant. No massive interest payments bleeding them dry while they're trying to scale up.
Correct. It vastly extends their runway. But the second thing, and this is where I expect you to push back hard, is the massive capital structure overhaul. Specifically, they executed a 1-for-10 reverse split.
Oof, okay. Yeah, I am pushing back.
I thought you might.
For anyone listening who doesn't track market mechanics daily, a reverse split is usually the kiss of death. It is what companies do when their stock price crashes below $1 and they are terrified of getting kicked off the NASDAQ. It is usually a giant neon sign of total desperation.
You are 100% right about that. In 99% of cases, when you see a reverse split, you just stay away. It is artificial life support for a dying stock.
So why does this report, which seems to be written by very serious analysts, think this specific reverse split is actually a good thing?
Because of why they did it. The report argues this wasn't just about mere survival or maintaining listing requirements. It was about strategic positioning. Penny stocks, which are generally stocks trading under $5, are often completely uninvestable for big institutions. Mutual funds, pension funds, the so-called smart money, they often have strict internal rules against buying penny stocks.
Right. They literally cannot touch them even if they want to.
Exactly. So by doing the reverse split and artificially getting the share price up into the double digits, BNAI was essentially putting on a suit and tie. They were making themselves formally eligible for institutional investment.
Okay, so they dressed up for the big party. But did anyone actually ask them to dance? Because you can do a reverse split, look great on paper, and still have absolutely nobody want to buy your stock.
And that brings us to the single most important data point in this entire document. This is the absolute smoking gun for the bull case.
The private placement.
The private placement. The report details that BNAI raised about $1.5 million by selling shares directly to private institutional investors.
Which, again, sounds fairly standard. Companies raise money all the time to keep the lights on.
But look at the price tag. Look at the price per share they actually pay.
I'm looking at it right now. $63.25 per share.
$63.25. Now, where has the stock been trading on the open market recently?
Around $30, give or take a few bucks.
Right. So pause and really think about that for a second. These are sophisticated investors. These aren't day traders on Reddit chasing a meme. These are major institutions that do incredibly deep due diligence. And they voluntarily paid nearly double the current market price to get into this company.
That doesn't make any sense on the surface. Why would you ever pay $63 for something you can just open your brokerage app and buy for $30 today?
It implies two critical things. One, they probably couldn't buy the sheer volume they wanted on the open market without driving a price through the roof anyway, because the float is quite tight. But two, and far more importantly, it signals where they think the true intrinsic value is.
It is like an expert art appraiser walking into a small gallery, seeing a painting listed for $30,000 and offering $60,000 on the spot just to make absolutely sure they get it before anyone else realizes what it is.
That is a perfect analogy. If they're willing to lock up their capital at $63, they clearly do not think the stock is only worth $30. They think it's worth significantly more than $63 in the long run. They are looking at that 2026 roadmap, those sovereign AI contracts in Africa and Mexico, and they are saying this is cheap.
That is, okay, I have to admit that is a very compelling signal. It suggests a massive disconnect between what the retail street sees and what the insiders see.
It is classic information asymmetry. The broader market sees the negative net income and the scary reverse split and gets spooked. The institutions see the signed deployment contracts and the clean, debt-free balance sheet, and they get greedy.
However, I do have to play the role of the cautious voice here, because even if the institutions are right in the long run, the chart right now is a total heart attack. I mean, the 52-week range is from a low of $1.18 to a high of $86.28.
It is incredibly volatile. There is no denying that.
That is not a stable investment. That is a roller coaster without a seatbelt.
And the report fully acknowledges that reality. This is not a stock for your grandma's safe retirement fund. It is a high-risk, high-reward infrastructure play.
The report also mentions some technical indicators that are flashing bright red right now, doesn't it? Even with the strong buy rating attached.
Yes, it does. While the moving averages are generally bullish, meaning the stock just had a massive breakout above the 20-day and 100-day simple moving averages, the RSI is flashing a major warning sign.
The relative strength index, what is the number at?
It is hovering right near 89.
Whoa. Okay. For those listening who don't trade technically, usually anything over 70 is considered overbought. 89 that is scorching hot.
It is severely overheated. It suggests that the price has moved up way too fast, too quickly, and mathematically speaking, it is highly due for a pullback or at least a cooling off consolidation period.
So if you rush in and buy today just because of the strong buy rating, you might immediately see the stock drop 10 or maybe 20% just on technical gravity alone.
Very possible. But there is a fascinating counterforce mentioned in the report that could negate that. The short squeeze dynamic.
Ah, yes. The absolute favorite phrase of the modern retail trader.
Indeed. The short interest right now is roughly 7.93% of the float. That means a very decent chunk of investors are actively betting against the stock. They are borrowing shares and selling them, betting the price will crash back down.
And if positive news keeps dropping, like maybe another one of those massive deployment deals in a new country, what happens to those short sellers?
They panic. They are forced to buy the stock back at market price to cover their growing losses. And when you have high short interest combined with a rapidly rising price, you get a violent feedback loop. The shorts buying drives the price up further, which forces even more shorts to capitulate and buy.
So you have this insane tug of war going on. The RSI is screaming to sell because it is technically too high, but the short interests and the institutional buyers are essentially saying, buy, it is going way higher.
Exactly. It is a total battleground stock right now. And that is exactly why the daily volatility is so incredibly high.
Let us talk about valuation for a minute, because when you have a company with such tiny current revenue but such astronomically huge projections, the standard financial metrics just sort of break down.
They look completely broken. If you look at the standard price-to-sales ratio right now, it is something ridiculous, like 1,000 times.
Which is laughable. You would never buy a company at 1,000 times sales.
You would never touch it with a 10-foot pole. But the report argues that is the wrong metric to look at for a company in this specific transition phase. They look at the forward price to sales. If BNAI actually hits that 3,200% growth target in 2026...
If. That is a monumental if.
A huge if.
Oh, why?
But if they do, that ratio drops from 1,000 all the way down to about 10.
From 1,000 to 10, that is a cliff.
And 10 times sales for a high-growth tech company with 80% gross margins. That is actually considered very cheap in today's market.
So the entire bet really comes down to execution. Can the management team actually deploy these sovereign AI systems in Mexico and Africa, make them work flawlessly, and get paid?
That is the gamble. The report actually compares them to a lead competitor in this space called Cerence. Now, Cerence is the safe play. They are mature, they are established, and they grow at a very stable rate of about 15% a year. BNAI, on the other hand, is the speedboat. They are burning fuel, the ride is incredibly choppy and dangerous, but their revenue growth rate dwarfs the industry average. They are aiming for over 3,000% versus 15%.
You are paying a premium for the sheer acceleration.
You are paying for the chance that they become the foundational standard infrastructure for sovereign AI globally.
So if we try to boil down this entire dense analysis report, the strong buy rating isn't based on what the company achieved last year. It is based on 3 very specific pillars for tomorrow.
Correct. Pillar 1 is de-risking. The crippling debt is gone, and the capital structure has been cleaned up via the reverse split to attract the big institutional money.
Check. That makes sense.
Pillar 2 is monetization. The enterprise deals are no longer just theoretical concepts on a whiteboard.
Wow.
Valio and Sky Salute are real, signed contracts for actual deployment.
Check.
And Pillar 3 is aggressive growth. The forecast for their earnings per share isn't just turning positive. The analysts are predicting 80% year-over-year EPS growth for 2026.
Which is exactly the kind of hockey stick growth chart that Wall Street absolutely drools over.
It is, but again, I cannot stress this enough to anyone listening. It is still a highly speculative play. You are essentially betting that the smart money who bought in at $63 fundamentally knows something the broader market does not.
It really is a fascinating case study. You have all the outward optics of a meme stock, the wild volatility, the desperate-looking reverse split, the potential for a massive short squeeze, but underneath all that noise, you have this surprisingly boring, serious B2B infrastructure play for hospitals and banks.
It is a very rare combination to see in the wild. Usually a stock is definitively one or the other.
It is a dense report, but I think we have managed to pull the real signal out of all the noise today. It isn't magic. It is just a very specific leveraged bet on data privacy and future regulation.
I completely agree with that assessment.
Now, before we wrap up this deep dive, I want to leave you, the listener, with one final provocative thought, something to really mull over on your own when you look at that crazy volatile chart.
What is the thought?
We spent a lot of time today talking about that private placement, the fact that institutional investors voluntarily bought in at $63.25.
Right. Nearly double the current trading price.
Think about the level of due diligence those massive financial firms do. They don't just read a quick article online and throw $1 million at a stock. They send in professional auditors. They interview the CEO and the board. They have software engineers look at the raw code of the AI. They probably called the actual clients in Africa and Mexico to personally verify the ink on those contracts.
Oh, absolutely. They turn over every single stone before writing a check that large.
Exactly. They saw the exact same ugly current financials we just discussed. They saw the reverse split. They saw all the glaring risks. And after seeing all of that internal data, they decided that $63 a share was a bargain. So the specific question you have to ask yourself tonight is, what exactly did they see in that long-term sovereign AI roadmap that the day-to-day market is currently totally missing?
That is the multi-million-dollar question right there.
Thanks for joining us on this deep dive into the BNAI analysis report. We will see you next time.
Stay curious.
Don't forget to like, share, and subscribe for more.